Thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to our continuing series of the Greenwich Roundtable. Our topic this morning, asset allocation for 2009, navigating the risks and charting the opportunities, is our annual symposium for the Chief Investment Officer. We started holding this discussion in the month of September because in the old days, investors were required to give 90 days notice to redeem by the end of December. Nowadays, lockups have lengthened, and we keep meeting in September to figure out which strategies to buy and sell. Today, we'll hear from two very bright strategists. I'll briefly introduce them after I say this. Our speakers' views are their own and do not represent the views of the Greenwich Roundtable members or its board. And also, I just want to, before I get into the biographies, I want to just ask you a little bit of housekeeping. You have a scorecard in front of you, a report card. If you can, think of a question that you would like to ask the investor community in general, because after this, Matt from Quinnipiac University and his team will be going out with a phone survey to investors. But we'd like to inform that survey, so if you can think of a question, write it down. And Mike Novogratz sends his sincere regrets as he could not join us today from London. He had to cancel. Starting off, David Malpass is the president of Encima Global, an economic research firm serving institutional investors and corporations. Before forming Encima, David was the chief economist at Bear Stearns, where he rose to the top of the Institutional Investor magazine's annual ranking of economists. Before his career in Wall Street, David was a deputy assistant Treasury Secretary, a deputy assistant Secretary of State, and the senior analyst for the Senate Budget Committee in the Bush and Reagan administrations. He worked on issues such as the savings and loan bailout, NAFTA, the Brady Plan for developing country debt, and the Fast Track Trade Authority. Sitting to David's left is David Merrin. David is the Chief Investment Officer of the Emergent Asset Management, a hedge fund advisory firm based in Surrey, England. David is particularly active in Emergent's private equity and advisory businesses, where he concentrates on the oil and defense sectors. Before he founded Emergent in 1997 with Susan Payne, David ran J.P. Morgan's European Market Analysis Group. He joined J.P. Morgan in 1986 as a trader in the bond, currency, and stock index markets. Before that, he was posted to the jungles of Papua New Guinea for a seismic exploration company, where he worked with local tribes and started to formulate his theories on collective emotional behavior patterns. And our moderator of the Greenwich Roundtable today is Ken Shewer. Ken is a co-founder and chief investment officer of Kenmar, one of the oldest independent fund of funds in the business. He's a trustee of the Roundtable and a member of our programming committee. As one of our gray hairs, Ken continues to lead our discussion on asset allocation every year. Ken, will the sun rise tomorrow?
Well, it's all over. Markets are up today. We're fine, right? Yesterday I was in a meeting in London on the subject of gray hair. Somebody who I used to refer to as a friend said, You're a gray-haired guy. You were around in 2008 and 2001 and 98 and 92 and 1987. And he said, just tell me, what was it like in 29 when you were sitting at your desk watching these markets? He was buying the S&P yesterday morning. I was very happy to report. Let me frame this a little bit for you. This morning's headlines: Wall Street Journal, mounting fears shake world markets as banking giants rush to raise capital. FT, credit panic hits historic levels. New York Times, stocks slump as investors run to safety. New York Times quote of the day. This quote is from Alan Meltzer, economic professor at Carnegie Mellon University. This is unique, and the Fed has never done something like this before. If you go all the way back to 1929, when farms were failing and Congress was leaning on the Fed to bail them out, the Fed said, quote, "It is not our business," unquote. These are risky times that we live in. As hedge fund investors, we have difficult decisions to make. The two Davids to my left are going to help us work our way through that. One bit of advice that I will start you all off with is consider liquidity of your portfolios. Consider it once, consider it twice, consider it every day of the week. With that, David Malpass, you want to start off?
Certainly. Thanks very much. Good morning, everybody. I want to give you my kind of worldview, how things work, discuss the current situation, and then talk about the outlook. So as we think about the worldview, I don't think in terms of long waves. So a lot of people look historically at at there being some inevitability to things. My analysis is much more event-driven. I think people matter, individuals matter, and so if you look back through history and look at the ups and downs of stock markets, I think you can look at the antecedents, and there's not an inevitability. So as we think about where we're going, I think it matters a lot what people do today, tomorrow, and over the weekend from Washington. The power of governments has become huge in this. So if we look back into the 1970s, what caused a terrible decade of stock markets? Clearly there were major events, decisions by Richard Nixon, decisions by the Treasury Department and by the world. Prior to 1971, the world had been on a gold standard, some kind of sound money. There was a big devaluation. Commodities went up for a decade. Remember, commodities were going up even though world growth was going down. And so you have this kind of inevitability only in the sense that as long as the dollar was going down, commodities were going up. It didn't mean a whole lot for where the world growth was going, but it meant a huge amount to sector allocation, to asset allocation during that decade. Also, there was the interplay in the 1970s with an unindexed tax code. So as the dollar weakened, everyone was pushed into this higher and higher tax bracket, and growth ground to a halt. So let's continue on this. As we think about the important events in history, they're, in my view, rather specific. So in 1993, remember Zhu Rongji, the vice premier of China, moved to the central bank, sat there and said, we're going to have a stable yuan, renminbi. And so that then changed the course of China's history. There's no inevitability to China growing and expanding and being a good market or creating value. They had a dramatic change in their economic policy in the summer of 1993. I did a Wall Street Journal article at the time trying to denote that event. And that made China a good investment climate for all those years. And so I want to take that kind of to an extreme. Japan in the 1990s, remember their real estate market started falling, their stock market topped in 1990. And then Japan chose not to do anything on monetary policy. Their real interest rates stayed high, and they fell into a long deflation. There wasn't any inevitability to Japan's deflation. Every month in 1991, 92, 93, 94, the central bank chose to have such a high real interest rate that the yen strengthened, the price of gold fell, and the banks fell into default situations. So that's the way I think about the history of this. A lot of people want to use kind of a different framework, and I think we'll hear a little, though I don't know fully David's views of empires in rise and decline. And I think from a market perspective, it's more practical to look at it in the very near-term focus. What are the events driving? If we think about the debt crisis, again, I don't think there's inevitability to having to unravel all the debt in the world. Remember, one of the strong forces going on in human progress is ever more assets per GDP. So if you think about the caveman, he doesn't have any savings over to the next year. His asset ratio, asset to GDP ratio is zero or infinite. And as people have made more and more progress, they build their assets relative to their annual output. And that's a pretty a hefty increase. And that just shows you progress. What we're all trying to do is have more that we earn this year that carries over into next year and the next decade and into our retirement and our children's retirement. So that means your asset to GDP ratio is going up and up. Well, as you have more assets, you're going to factor them more. It's, I think, inevitable that you're going to have a higher and higher debt to GDP ratio. That doesn't spell the end of the society or really have any negative implications for the long run. The debt to GDP ratios have been going up because the asset to GDP ratios have been going up because there's been long-term progress for humanity, and we can try to define that in terms of the fall of the Soviet Union or the march of markets or however you want to think about that. Okay, now coming to the current situation then. I don't think there's an inevitability to what's going on. There's been specific government choices along the way, and these are critical choices to how the markets are unraveling. The SEC has decided after Enron, remember they put through Sarbanes-Oxley. That was a whole new accounting regime that's pushed itself through the FASB regulations and through peekaboo, the part of the SEC. And what it's causing is this extreme caution within the auditing profession. Remember, Arthur Andersen went belly up after Enron because it hadn't been cautious enough in inspecting the Enron books. So if you're an auditor sitting now with criminal penalties facing you, you seek the lowest possible price to put on anybody's assets. And that becomes an unmeetable standard, meaning we're all bankrupt as long as that goes on. I keep thinking someone in Washington is going to stand up and say we're reviewing those standards because they don't work. So that's a critical event in the outlook, is when are they going to provide some relief to unreasonably low valuations on everybody's books. Another part of the current situation is the rise of the CDS market, and people are using it as a measure of risk when it has no business being used as a measure of risk because it's an unregulated, thin market. And so what's happening, I think, is an interaction between the bond rating agencies who have started using a company's stock price to evaluate their bond, the likelihood of the bond paying. That creates an internal spiral, which is very powerful. And to further the matter, they have conservative accounting standards, and then they're using the CDSs as a valuation technique. So all of a sudden you have AIG, a perfectly good company with a long-term prospects, going under in a matter of weeks. So as we think about the current situation, it matters a lot exactly which changes Washington chooses to make. I worked 9 years in Washington and saw individuals stepping up and making a difference in the course of how things worked out. So that's what I'm watching right now. I don't think it's possible to say when will the market bottom because there's going to need to be techniques. Now on that, people are looking at LIBOR being wide and saying this is unworkable. The Federal Reserve is super powerful in these kinds of situations. When I was at Treasury, we did bridge loans with the Fed, so it was a 50-50 bridge loan. I was responsible for the bridge loans with Brazil, Mexico, and Argentina. The government could roll huge amounts in conjunction with the Fed to keep those countries afloat. So if you could keep Brazil afloat in 1987, 1986, you can keep individual companies in the U.S. And remember that what they were doing was this holding action to roll that debt until Brady bonds could be created as an instrument, and that required accounting forbearance. Remember, the trick of the Brady bonds was you had a menu of options that would allow each bank to account for it in a way that worked within its regulatory capital structure. So that's kind of the process. The Fed's got all that history. It's the same people working there, same people working at the Treasury as in the 1980s, and they know how to do this. They just haven't done it yet. Final section is the outlook. I think basically then, under my view, we have a relatively sturdy world. As you think about what 2009 and 2010 looks like, if you want to be, you have to guess or assess how bad do you think the split is? Remember, the defining moments of our current crisis was Greenspan picking 2 years of 1% interest rates and then measured hikes. So the world is chock full of money, and so then you can say how much of that was wasted. If you think a lot of that was wasted, then you want to be pessimistic. We may have 5 years of workout. I think most of it was used effectively. Brazil paid off all their dollar-linked debt and has a long maturity curve. So Brazil is sturdier than any of the previous decades, and down that list of changes. And so if that's the case, or to the extent that the split, in my view, was not that many of the green, he put out 10 trillion extra dollars, and maybe 1 trillion or 2 trillion was wasted. That means 8 trillion is sitting there ready to build the recovery once they sort out this accounting problem. So I think the world in 2009 then will be inflationary. This is patently not a deflationary environment. This is not Japan in the 1990s. Remember, Japan had actual bad debts. These were not accounting bad debts. These were non-payment. In the U.S. now, we have accounting bad debts, whereas the loans are still being paid. The cash flow is fine. So this is exactly the opposite of Japan. And remember, Japan in the 90s was deflationary, meaning gold was falling and falling. There wasn't enough money. And so this is a mirror image of Japan, and people shouldn't think that we're falling into some kind of a deflation spiral. This is a very stimulative monetary policy that will work once they get the accounting problems sorted out. So that leads me to an asset allocation that includes some commodities, includes a lot of emerging markets. They come out well in this because they weren't sucked in. They didn't build too many houses, whether even in China, especially not in Latin America, not in Eastern Europe, and so on. Now, in Spain, yes, so there's a housing bust going on in Spain, but that's a somewhat isolated event. So I want to be in an asset allocation that's equity-driven, that recognizes that after or during an inflation, equities tend to be a protection from that. Earnings tend to go up because there's pricing power, which I think we'll get into that phase. Clearly, that's not the asset allocation for today. We're in an all-out crisis waiting to see how the Fed is going to sort it out. But looking into 2009, I think it argues for a relatively aggressive acceptance of risk after this long period. We've been in a 2-year period of de-risking in portfolios. So I want to be more on the risk side once we see the events that can create the recovery. I'll stop there. Thanks.
David, you, with your vast experience in both government and working in some of the large institutions that
collapsed,
that are no longer around.
I was with Arthur Andersen in their consulting group in the 1970s, so well before the collapse.
And you speak about the moves that the government can make, should make, will have tremendous impact. What do you think about Alan Greenspan's proposal that an RTC solution is the right way to go, and that's the only way to really contain the current situation?
Yeah, I don't think it makes sense. I've been critical of Greenspan. I think he caused this problem, and to some extent then is covering his tracks as he makes proposals. The problem with the RTC, I worked on the FIREA legislation. So in 1989, I worked for first James Baker and then Nick Brady, as Brady came in and said, we have to clean up this S&L problem. And the government put forward in January of 1989, I went with Brady to meet with Don Regal, the chairman of the Senate Finance Committee, and I think it was Freddie St. Germain, chairman of the House Financial Services Committee, and they created a really tortured structure of legislation. And the antecedents, this had been a problem that had been growing for 3 or 4 years. There had been S&Ls falling into negative net worth that the government would not close down. So the savings and loan bailout, the creation of RTC, was years in the making, and it had the benefit of the assets were right there, meaning the government had already taken over a failed S&L. So I don't see any corollary to that. I think the Brady Bond plan is a better analogy of what we need now. Someone needs to securitize the bad assets and sell them at a discount, and take the accounting away from these institutions. As long as you've got equity capital constrained institutions holding assets that the accounting profession wants to put down to zero to protect their behinds, then you've got a problem. So we've got to have some way that either private equity or the government takes the bad assets off and packages and sells them.
Yeah, I would add to that also that an RTC solution would mean probably couldn't take place until 2009.
Yeah, well, 2010
or 2000. Well, it could be put in. We could put it into action in 2009. I think you would agree. There's no senator or congressman on the planet that would want to get involved in that debate right now, and so we'd be 6 months until it could even be considered. And if my memory serves me, from when it was voted as the right way to go, from there until it got started, it was another 6 to 7 months, I think, so we'd be looking at early 2010, and I think by then it would probably be too late.
I'm frustrated by the leaders, the elite. One guy will say this and one guy, and it's often just a diversion. They don't want to deal with the problem that the accounting standards are broken and that is driving everybody into bankruptcy. So I'm frustrated when you see those solutions that are not likely to have any impact come out and get a lot of attention. People are now talking about the Fed cutting interest rates. Well, that's been after Katrina. People said the Fed's got to cut. At every point, no matter how low the real interest rates, people keep saying Fed cuts are some kind of solution, which I don't view that constructively either.
Well, interesting that you mentioned the Fed cuts. When I saw that the Fed was holding the line on Tuesday, my first reaction was the Fed's going to bail out AIG. Mm-hmm. Because if they had not bailed out AIG, I think they would have perhaps taken a more aggressive view.
Can I take one exception? Please. The word bailout. The Fed did this odd thing. They took equity participation in AIG, so we have this massive catch-22 from Paulson. He doesn't want to be blamed for bailing anybody out. Well, that means we all go to zero, because if the government's solution is you all need more equity capital, but your equity has to go to zero before we'll help resolve anything, that's an unworkable catch-22. So now, I do have a little hope. It looks like the Fed is taking more and more of a role. They're dominating over Treasury. It's coming out of the New York Fed. And we may start seeing deals where the equity can actually go up. You can imagine a resolution of Morgan Stanley where the Fed supports some kind of a deal and the stock goes up. I don't know that deal, but if that happened, it would break us out of this catch-22. Paulson would be sidelined, and that would be very helpful to the situation.
And couple that with the fact that the U.S. government now owns 80% of AIG, and AIG is paying the U.S. government 850 basis points over LIBOR for the loans that it's making. David Merrin to my left, before he speaks, I feel as if it's only fair as a fellow member of the Roundtable. Similar to smoking cigarettes, there's a warning on the package. It says, "Be careful, smoking may be dangerous to your health." All I can say is buckle your seatbelts.
Thank you, Ken. I agreed to come and speak with a jacket and tie. In fact, I agreed to turn up. I have a rule. I don't speak with a jacket and tie, so excuse me while I take it off. Right. David's right. I have a very different view of what drives the world. And in a short time, I'd like to give you some inklings as to how we think the world's unfolding and how we got here. But first of all, I'd like to transport you to a completely different situation. You all fly regularly, and you've got on an aeroplane. It's a normal day. The aeroplane has taken off. You've been flying for half an hour. And you're relaxed as normal, and all of a sudden there's an incredible bang. Bang comes from the port wing, the aircraft starts to shake. People start screaming. There's a voice over the tannoy. We've had an accident, our engine's on fire, the fire's out, but we're going to have to make an emergency landing. You are scared. You have a right to be scared. You're told to adopt the brace position. You do that. And half an hour later, the airplane comes in for its final approach. It hits the runway with an incredible bang. You've never felt anything like it in your life. The plane screeches down the runway on a collapsed undercarriage, and it comes to a grinding halt. There's silence. What are you all going to do? I hear you think, I'm going to get out. I'm going to get out of that plane as fast as I can. But you're not. In the Manchester air disaster, 90% of all people stood up because the plane stopped. And what do you do when a plane stops? You take your hand luggage out of the overhead parcels, and you hold your hand luggage and you queue up. Despite the wisps of smoke entering the fuselage, you wait. 10% of you will be hardwired differently. You're the survivalists. You're the mavericks. You identify that you have 60 seconds to get out of that fuselage or you will die. You crawl over the backs of the seats, whether someone is there or not, and you get out of the airplane. Meanwhile, the people holding their hand luggage die. That's a true story. And if you look at many situations of survival, mankind is bifurcated into those that literally short fuse when you get extraordinary circumstances. And what you do is you try and make everything normalize. The other groups realize something unique is happening, and they take action. And you can imagine why I tell this story. Because right now is not a normal set of circumstances. And I'd like to take a show of hands. How many of you at this stage, please hold your hands up and participate in this, are bearish of the US stock market? And how many are bullish? Okay, so we've got a couple of bulls here. How many of the people that are bearish are going to make money if the market drops 50%? Right. Markets are about psychology and perception. There are two things that happen as a trader. If everyone is bearish and everyone is short, you're probably about to get your head ripped off. If everyone is bearish and they're not positioned, 1 in 10 or 1 in 20 of those events accelerate. And if you look at the paradigm of what's taking place, I believe that the dam that Fed has created to do with the stock market prices means we are now very susceptible to a proper crash. A 1 week or short-dated event where essentially the stock markets in the US moved to their 2003 lows. And if you ask yourself the question about the economic environment now versus 2003, is it better or is it worse? And I think honestly you'd have to say worse. So why has the stock market not reflected that pricing mechanism? Now I'd like to transport you, having asked the question, to a big picture. After 9/11, I remember doing all my best thinking in the bath and thinking, my goodness, the world has truly changed. I've been in investment for 15, 17 years, and every investment anyone ever makes is on an economic basis. But this is the dawn of a geopolitical world. And none of the investors in this world have a geopolitical background or a model to understand and expect what happens next, which should affect every investment you make in this room. And this model was created on a number of thematics. One of them was the evolution of a multipolar world, which in 2001 was a pretty advanced concept. America would dominate the globe. It seemed impossible to think that Asia would rise so quickly. The next area was based on commodities, and I am a great subscriber to the Kondratiev cycle. Unlike David, I believe that we as individuals have inevitable cycles. We are born and we die. And the cycles of our behaviour in between are relatively predictable, although we feel like we're individuals. We reach a peak one day of our power and our influence, and one day it slips away from us, we don't quite realise it, and we're looking back at where our influence used to be. And that is a basic fractal of civilizations. And I've done an awful lot of work in a model that I created called the 5 stages of empire. It's about how a system becomes regional, and it would be Rome, the city of Rome dominating the peninsula of Italy. It's now a regional power. Driven by demographics, that influence expands. It has to go out into the world to gain commodities to feed its growing demographics. That happened to be China in 1996. And it moves to the second phase, which is ascension to empire. That is an exponential process. It breaks all our linear expectations of change, which is what's been going on in China. At some stage, you get an algorithm where you absorb empires around you and civilizations at an incredible rate. It took Rome 700 years to regionalize and about 100 years to become an empire. I think China's rate of change, it's taken about 100 years to base and become a regional power with its civil war and evolution, and now you're into the extension of empire, which can be very quick, quicker than we'd imagine. I think this next phase is going to be much more accelerant for its power base versus the West, as its higher growth rate insulates it from the inflationary pressures that the very eastern countries have produced on commodities. And then you reach a point where you're mature. You bend over the top and you expand to your geographic domain and you balance your economies. And essentially, you go into overextension. Overextension is when you can't afford your system. You can't afford your defense expenditure. You can't afford to project power. And America's actually been in overextension up until 2001. 1990 to 2001 would be the period, I'd say, it was overextended. But once you meet a military challenge, all of these systems start to buckle. And your military challenges were in Afghanistan and Iraq. Just like Britain in the Boer War, we did win that war, but it took us 5 years to beat a group of farmers. And the Germans looked at us and said, you know what, that empire is weak, it's old, it's ready for the taking. And it accelerated the ambitions of the systems around that were rising. In this case, the Asian systems. And right now, this financial situation, which I do not believe is just an event, it's not an accounting issue, it's to do with overextension coming home to fruition in a power base that can't actually manifest power in the outside world. It's a lack of confidence in American power and the image. I do not think it ends well. I think it's a magnitude bigger than 1929, because the underlying pattern for America was growth in 1929, whereas the underlying pattern for America is contraction. And I would like to take you back to the degree of this contraction. The Western Christian Empire has been dominant for 1,000 years. It started with the Portuguese, it expanded to the Spanish, then the British Empire, and the American system took over from the British. When you took power from us in Suez, you cushioned the evolution of the change of our empire because you stepped in and you had similar values. But as America, you're like the Byzantine Empire was to Rome. You're the last vestige of that value system. So the decline can be very precipitous as a result of that. And the other thing that took place, if you think of power on a relative basis, American power near its peak of 2001 seemed enormous compared to the rest of the world. But compare it to the peak of the Western Christian system in 1914, and it was much smaller. The mother culture reached its peak before its civil war, and that civil war started to dissipate the system. Now, the big question I used to ask is, why are we facing simultaneous challenges from Asia, from India, and from the Middle East all at once? And quite simply, this great empire was a sea power, and it moved away from its normal area of influence to the rest of the world, and it suppressed the other pistons to zero. And what that essentially meant was for 100 years, they've all been moving upwards into the vacuum as we created a power space. So you see it in the Middle East, you see it in India, and you see it in Asia. And it's all driven by demographics. We look at a person and say, you know, you're 55, therefore you're semi-energetic. You're 80, therefore you're less energetic. You're 14 and you're mad and crazy. We know that ages have characteristics, and demographics produce characteristics in nations. So in the West, we have stationary demographics. We bring Mexicans in, or we bring Eastern Europeans in to increase our numbers. But in effect, our underlying culture is flat. The demographics of China, of India, and Africa are massively rising. And what that does is create a mode of expansion. It's an expansive thought process. And in the case of China, with 57% males, it creates this extra risk capital when the time comes to transfer their economic power to military power. And I was asked to give you some ideas about things you need to consider. And I would urge you to do a number of things. Consider, first of all, the seriousness of the American system. This is not a glitch. Yes, there can be mechanisms to pause it, but ultimately I think the outcome is relatively inevitable, unfortunately. Because when systems decline quickly, the power vacuums that come with it create huge instability. The next is what you do with your money if you go outside. Well, we're real fans of Africa. Africa is early regional. Lots of different countries competing for power, lots of demographic increases, huge raw resources which China invests in, which stimulates the system. So we have an awful lot of interest in Africa and agricultural areas and also underlying businesses. I think that's very manageable. Countries like India, for example, I want to bring that up. India appears to be like China. It's 15 years behind in its demographic curve. The problem is there is only one resource base that can source and power an empire, and that's Africa. And China's got there first. So in effect, I think of India as stillborn. The other problem with India, which is a huge risk for your investment programs, is that India is led by a Sikh currently. It's still mentally in a mode that is about partition and regional power with Pakistan. Although it is the dominant power, the dynamics of Hindu fundamentalism and Islamic fundamentalism are ready to be inflamed at any one stage. And China's strategic game in the world has been very successful. They pushed America out of the Korean Peninsula by using their satellite North Korea in its nuclearization process. They accelerated the Iranian nuclear program by blocking them in the Security Council. And they are looking and hoping that Chinese interests will essentially be accelerated by Pakistan's current move towards fundamentalism. And unfortunately, our failure to consolidate Afghanistan is providing the fuel in the eastern provinces. So what that means is you can have a fundamentalist Pakistan with its nuclear weapons, which is a big issue. And more importantly, once that happens and you remove a Sikh Prime Minister in India, you have a really, really dangerous situation. So whenever I think about investing, I think about the bigger picture. So you obviously look for price opportunities. That's some of our business too. But think about Russia. Russia, for example, is an example of what I call a hybrid, mature culture. Its demographics are the worst in the world. They breed at an appallingly low rate, but they're immensely rich. So the caricature of the country is a rich old man that wants his power back. And unfortunately for Putin, he's made a few big mistakes. He's consolidated power into large oil companies. And the distribution of oil wells is such as there are a few big ones and there are lots of small ones. And the real way to increase reserve capacity is to develop smaller businesses which hit the smaller wells. But by consolidating into the bigger fields, they can't find bigger fields to increase their balance sheets. So their reserve ratios are going down, and they are not investing in offshore oil rigs to go north, and even if they did, it would take 15 to 20 years with a lag. So Russia's moved a little bit early. It is expansive, and it will take advantage of any gaps in American foreign policy or willpower to deploy. And unfortunately, NATO has been expanded way beyond its defensible boundaries, and the Russians understand that. So we refused to invest in Russia for 18 months, and if the geopolitical picture isn't a good one, you should see doing business there where you sit down for a meeting and they start to threaten your life for the first 20 minutes. It is a serious Wild West situation that's now gone right the way down to the smaller entities away from the oil oligarch system. So staying away from Russia is something which we have been a big advocate of. Wary of India, wary of Pakistan, like Africa a great deal. Thematically, oil rigs. Look for oil rigs and look at the reserve ratio replacement reserves in oil. You will see them declining. We have found all the available oil on land of meaningful size. The only place to go is offshore, and you look at the rig building rate and you look at the day rate that's been going through the roof. There will be a moment, I am sure, where oil will dip to the point where chief executives will remember the 70s and think, whoops, we invested in infrastructure and it hurt. Should we check ourselves? That'll be a mistake. It's the one chance the West has to, in some shape or form, fill the supply-demand gap. Unfortunately, with our capital structures, though, we have a big problem in supporting rig construction for 3-year periods that doesn't produce yields. So we have lots of hallmarks in the West of an old system. We're not looking to the future. Our financial system has failed us in providing infrastructure. And ultimately, it's been kept, and this is the key thing, is what do you do when you're overextended? Well, we saw 3 crashes that we worked with. One was Asia, which we predicted accurately from top to bottom. The other was Russia, which we got right until one thing happened. And there's a salient point for the current situation. When the IMF bailed out Russia and the bonds were 44, everyone clapped their hands and said, good job, boys, it'll go up now. It stalled for 2 days and then it dropped 40 points and everyone was completely cooked. So beware of bailout packages when people become complacent that they work, because after that, if they fail, you could end up with a huge break of price mechanisms. The other one that was really interesting was Argentina. And before you say, how can you compare the US to Argentina? At the time, it was the darling of the emerging market world. It was the best of class. And unlike Brazil and other countries, it stalled. It wouldn't go any higher, which was a warning sign in price. We shorted those bonds at 86. They dropped to 50. We thought we were pretty smart. They went back up to 76 as the government got the pension funds to buy their own bonds. They did everything they could to protect the mechanism, and when it finally went, it took everything with them. So I would say the Fed are the most sophisticated group of people ever at intervention and keeping this mechanism alive. They've been doing it for years, in my opinion. I think from the time America went to war, they had a completely different mandate, which was to generate price stability, economic stability, from which you could go out and project power into the world. And as Volcker said in his quotes, the Fed of today is a very different Fed of a previous period. It's a strategic geopolitical asset to the state, so it was until the bubble became too big. So I think there are some huge things here which are beyond individual decision makers and policy makers at this stage. And it's a question of, yes, the Fed has done a brilliant job of protecting it to this point, but you can only protect for so long before a dam breaks. And I think we need to be prepared for that dam. And that dam will have consequences in a lower rate scenario. It'll make Japan a phenomenal investment opportunity. Although you laugh, it's because it's 13 years ahead of the cycle. Basically, as the world's Western interest rates compress and the spreads go down, the Japanese currency and the Japanese market becomes one of my favorite areas. And especially because it's a strong ally of America and is replacing American power in the Asian region to block China. And the other thing is the dollar. We've had a huge correction in the dollar. If you were a bearer of the dollar, you probably had a very painful 2 months. I suspect with the dynamics that are going on now, and you'll see for the next phase, if the next phase is to continue soon, you'll see it reflected in the dollar first. And gold is always an alternative currency. I've moved very quickly through actually what is a complex geopolitical idea. It's easier for you to ask questions, and I can use the model to give answers to it than it is to actually cover it in 15 minutes or so. Ken wanted me to speak.
I warned you. David, I have a few questions, but since I kind of know the answer to this first one, give us your optimistic and your pessimistic view of where you think the Dow will be in 6 months and 12 months.
Okay. First of all, if you look at a price pattern of the Dow, I have no doubt in my mind that this does not end until we reach the lows or below the lows of 2003. So then it's a question of how the timing plays out. If you look at the rate at which the organizations of finance are falling and their entwined nature, you've got to think from the moment Lehman's went down, the pricing of assets can no longer be something that an actuary pretends anymore. That's going to run through wildfire like the system. So I think it's more like a near-term thing rather than something you can create a pause in which case, I just keep thinking of this image of a dam. The Fed have created a dam in stock prices. And you've got to wonder what straw piece will break before it goes down. And we've always come up with some very interesting ideas before their time. And about a year and a half ago, I actually did something that almost caused people to throw things at me. And that was essentially, I thought Goldman's was particularly vulnerable. And when you think about it, all systems have icons. And this is an important concept. It's not, capitalism is failing, it's linked to America's power status. And that capitalist system has icons, and Goldman represents one of the biggest icons around. We saw it in Europe in Vega. It was invulnerable until it literally disappeared, as some of you might remember. And with Goldman's, I suspect, and it's always hard to know what the reason is, the caricature of its positioning within the overall cycle and the confidence of the people and the perception of that confidence is actually one of the big bellwethers and hallmarks. And I think the thing that may catalyse the drop is the least expected entity to go down. So in this environment, don't look at the ones in the chain as you run through it, with Wachovia and other end. Look for the ones you never expected, because that'll be the moment this is just way bigger than we thought, and that'll be when the dam breaks. So it may not be Goldman, it could be some other entity, but it's always been my thought that Goldman is more vulnerable with $1 trillion hedge fund. You cannot be a contrarian entity with $1 trillion hedge fund. You've got to own what everyone else had in various degrees, and it's a question of just how you mask that. And they've been very effective up until now.
Thanks. David, I was in London yesterday, and when I checked out of my hotel, a young Indian gentleman, the doorman, said to me, "Where are you going?" I said, "I'm going back to New York." He said, "Oh, you're American." He said, "Bless you." He said, "Because it is we need America to lead us out of this economic crisis." By the way, I apologize. This sounds like one of Steve's questions. Yeah. Go easy, Steve. We Americans are an opportunistic and optimistic society. My question is, will that optimism be our undoing, and will the demographics, as you suggest, of developing nations, coupled with their demand for commodities over time, coupled with their high budget surpluses, create are we decoupled, and will they lead us out of this?
Well, there are a couple of things. If you're being really simplistic, and I subscribe, and we were very early on the oil cycle, very early on the agricultural cycle, and recognize it because of our understanding of the contractionist wave, which we think started in 2000. And what's important is if you could model the Cold War on a simple bias of a consumer society versus a commodity society. Now, it's a little more complex because America's need for oil started in the 60s, which started to import it. And the peak of power was for the communists versus the capitalists, which were consumers, was 1975. So one of the elements about what's happening with commodities is that we probably could have survived longer with our bubble if we hadn't had imposed upon us this huge inflationary commodity cycle from the East. It's going to be with us. There will be demand destruction in the West to some degree, but it will be supplemented very quickly in the East. So this is the pause in the commodity cycle. It's not the dip, and it won't disappear. So if you're thinking about how to treat it, you may need to watch yourself short term, but you don't want to give up the idea that this is the dip before the really powerful trend in the future. Those trends normally lead to conflicts, by the way, and that's why I have to be pessimistic, because when you have a power change and you have new economic powers, they never in history do not manifest themselves in military projections of power. And you are seeing an arms race in the Far East right now in terms of naval expansion in China, in Japan, and in India, all about the trade routes. If you read into it more and more, it'll only accelerate. America's been very smart in letting the Indians have one of their aircraft carriers, and you brought India. Probably Bush's smartest policy ever was to bring India in as an ally of America. It's a brilliant policy. Offer them one of your aircraft carriers when it was old. So if we had an extra aircraft carrier in region. Cunning move. He hasn't got a lot of press because everything else hasn't gone right. But that was smart. In answer to your question about demographics, I always like to reduce it to being an individual. And I think about this. We cannot defy the mechanisms of age. If we look after ourselves, we live a bit longer, we are more vital, we keep our intellects. And if we don't, we decline earlier. We try and balance that as intelligent people. And I do believe, because of the demographic cycles, and I've studied pretty every empire system in each of the systems for 4,000 years, and this cycle keeps returning. It's full of people that don't recognize the cycle, but the cycle is there. It's to do with the way social organizations build and fall. All you can do is responsibly recognize you are aging and try and pass over that stakeholdership to the next entity. Now, no civilization in history has ever managed that because we are, as you say, optimistic. We always want to believe the same thing that drove us to the peak, that it's not the peak and we will fix it. And we will get back to the peak, but the reality is we don't manage it. So American optimism is not unique. Other systems have replicated it. And the big shock for me was I used to think Anglo-Saxons were incredibly creative. Something about our genes, something phenomenal about us that made us different. And, I look at Britain, I look at America and the number of patents. The truth is, when you ascend to empire, you become very creative and expansive. So the only relevance we have is we're the last ones that did it, so we remember those lessons. But look at the number of patents in China. Look at the way they're solving solutions we hadn't thought about. They are not just copying, which is the first stage in regionalization. They are now creating new things. You look at the US defense and you look at its network-centric warfare and you think you're absolutely invulnerable. So what do? Get 100,000 hackers. And they put them in rooms across China and they try and break into all your computer systems. They use manpower and intelligence in ways that we just didn't think about in our society. They are becoming creative, very creative. So my answer to you is that optimism is a hallmark of this particular part of the cycle because you wouldn't have built a system if you hadn't been innately optimistic.
Well, David Malpass, what do you think of this particularly toxic presentation that David has just put forth?
I'm an optimistic person, don't get me wrong.
No, he's not. No, he's not. He tells that to his wife every day of the week. She doesn't believe it either.
One of the reasons about this is if you don't understand truly the terrain you're investing in, you will have a horrible shock. If you are realistic about that terrain, there are lots of opportunities out there. They're just not conventional opportunities. They're not ones shared by your peer group, but they are there to be found.
I agreed with some of the conclusions. I didn't agree with the kind of fatalistic approach. So I want to take some of the examples David used and put a different spin on it. So Argentina was mentioned as kind of an inevitable crash like what the U.S. is going through now. But remember in the years escape me now, 1997... 98, Domingo Cavallo was running for president and said that the currency board should start using euros in the currency board. It was at a time when the currency board was completely dollar denominated and the euro was crashing. And so it was, in effect, a disastrous Cavallo had created the currency board and was completely pulling the plug. So Argentina collapsed immediately under that pressure. If we look at the 2000 change mentioned as far as the commodity cycle, in my view, the critical bottom in the commodity cycle was in 2001. After 9/11, Alan Greenspan said, I'm going to provide all the money the world needs. And that's when commodities started up. The bottom was formed there in August and September, even as people were thinking about the deflation. The commodities were rising because of the monetary policy event. As we look at our current situation, we kind of say, well, the bond market is really negative, so that must inevitably drag us down. Remember, the last time treasuries were this low was in specifically June, July of 2003, a major equity market bottom at the depths of pessimism in the treasury market. It's because now, and so I'll quarrel with your survey of hands. People say they're not positioned for a down market. You tricked us a little because you said a 50% down market. Well, we're not ready for that. That's true. But based on the ownership of treasuries and therefore the width of the credit spread. So credit spreads are being widened because there's a narrow benchmark, which is the U.S. Treasury's outstanding. It's a drop in the bucket of global needs. And so that's giving you a false signal, just as it did in 2003, and for the same reasons. If everyone panics, they go into treasuries, and you're left with the impression of wide credit spreads, which doesn't end up being a leading indicator at all during that moment of crisis. Remember well, June of 2003, the 10-year yield went to 3.15, something like that, and that was the exact moment of the bottom. So I think we're kind of in that kind of situation. Now, I don't want to go too far with this because, okay, I agree with you. Japan is well positioned. I agree with you that Russia is badly positioned. There was the critical event that Yeltsin handed over to Putin, a strong authoritarian, maybe bad guy, and Russia is in, so I'm not disagreeing there, nor with your India characterization, nor with concerns about the dollar. And I don't even disagree with your immediate concern. We're in an all-out crisis right now. I'm waiting for the events. And final point then, my colleague Tim Collins is over here. We're going to hand out packet at the back. My article in the current issue of Forbes is about a Reagan redux. Your whole presentation could have been given almost to a word in 1979, 1980. And then an event came along. They changed the head of the central bank. Reagan did his thing with tax cuts. And the end of empire, people were talking openly about end of empire, American empire in 79, 80. And it just wasn't the way to look at the world. Please.
I love this because one of the things about investment is if you ever think you've got the answer, you haven't. You need to be challenged all the time. So running through your list, my parallels with Argentina were far less an empire in decline because Argentina wasn't an empire. It was actually mismanagement that caused the problem and then the intervention that was ultimately not enough. I think, and I must position myself as someone that was brought up travelling to America. I've had links to America since I was a child. I'm incredibly fond of America. So when I come here and present the discussion of this painful topic of where the cycle is, it's probably with the perspective of being a citizen of a system that lost its power a number of decades ago, and I lived through the early phases of that realization. It's not without sympathy, and it's not in any way in a form that gives me any pleasure. It's a very dangerous thing for the world. But when you mentioned that it was Greenspan's free monetary policy that created the commodity cycle, I would actually say you've got to stop being American-centric. The driver to commodity cycles was the demographic in the East. This new empire that's growing out there at a rate that is staggering. Look at your infrastructure out the door and then go to China and be blown away by the magnitude and the technology they're employing. Greenspan helped His increasing mechanism created the liquidity that created the bubble, but that wasn't the commodity cycle. It's fundamentally driven by a new power source that needs that energy to build itself. And that's really the key, is that this is a challenge which is not in the future. This challenge is accelerated and developed, and the biggest change to the power. We think we've seen a power change now. And the model that I would give is just be simplistic and apply a 5% inflation number to the whole world. This inflation that we're getting in the West isn't ours, because we're not growing. We're stagnant. It's an Eastern system in a globalized economy. Now, if we have 0 inflation, 5% inflation and 0 growth, we go backwards. If they have 9% growth and 5% inflation, they go forwards. The damage to systems that go backwards, their social consequences and the way politics changes are enormous. So I would make the argument that with or not this financial change, the current stagflationary pressures are about to accelerate the growth of Asia versus America and the West. And one number to leave you with is that America has been wise to commit its resources to ongoing defense policies that gives you a decade of lead in many areas of defense. You spend $17 trillion a year on these mechanisms, and they're not easily emulated. But when you look at the Chinese roughly $3 billion or $3 trillion of investment, it seems small and they're well behind you. But if the dollar goes down 50%, all of a sudden the purchasing parity of that is completely different. And those are the sort of non-linear changes that history really has been defined by, not by linear projections. And I would encourage you to start thinking about hockey curve changes, not linear changes.
And the 1980 analogy?
That's an interesting one, because 1975 was the peak of a Kondratiev wave. And it was the worst situation for America. It was in Vietnam. It was suffering a minor version of this. It was squeezed by commodities. It, really, and it's right. But very often you see in stock markets, you see peak 1, peak 2, final peak. And the echoes of the 3 peaks are very, very similar. So I would say that was a precursor that growth took you out of. But nonetheless, you can't just say because the last one didn't work, this one isn't it. And I can understand that there are similars, and for example, stagflation. It's always great to talk to the older members of what was stagflation like. How the hell do you invest in a stagflationary world? Well, I'll lay the bottom dollar. Whatever the answers were the last time, they're not quite the same this time, because it's not our inflation. And I had a big argument with the second in command of the ECB when he spoke at his dinner. And he was really proud of their inflation-fighting policy. And the legacy came from the Bundesbank, which was fight inflation, do a good job. And I said, well, when you do that, you're just going to kill growth, because it's not our inflation like the 80s. We didn't have high growth, high inflation, kill one, and you get the right outcome. This is someone else's, and all you're going to do is destroy Europe and send it backwards. And he said, yes, but what we're going to do is we're going to get if you say that 70% comes from energy inflation and 30% comes from services, we're going to squeeze services so tightly we're going to compensate and get our inflation targets down. And it is a good example of the dogma of the past that takes us into trouble in the future. And thank goodness for America that you have a Fed, which I have huge respect for. The judgments they have made, given the hand they've got, has been incredibly astute. If they weren't as astute, this would have been taking place months back. But the trouble is, you only have limited resources, and the question is, how many more resources versus the size of the problem can hold it down there?
While I find the 20, 100, and 1,000-year discussion fascinating, I'd like to take it a little bit down to today. One of the biggest risks that we see in the market is credit default swaps. We think that's the next could be the catalyst for the next leg down. Fannie and Freddie being taken over by the U.S. government is now stable, and they feel as if they can control the defaults to something like 5%. If 5%, if the number, which nobody knows exactly what the number is $500 billion, that's $25 billion of defaults that are probably backed up in monolines and different insurance companies by about $1.25. What are your thoughts on that?
I think that's a meetable challenge, meaning that would be a very good case outcome from this. So as people talk about the CDS, market, they're usually talking notional, meaning the gross exposure. I'm comforted, maybe wrongly, we'll see. Lehman is providing a very good test of how that market clears. But it seems to me that if you have a zero-sum market, meaning I'm betting against you on the weather, and now we're suddenly finding ourselves betting $1 trillion on the weather. It's got no impact on GDP, and however we settle it is not really going to matter to the world. These are rich people making abstract bets, and so I don't see that it drags the system down. You can have a full implosion of the CDS market, meaning the notional exposures are canceled out without it having much impact. We're seeing a test of that now with Lehman, but if you can go through a Lehman default, a very sudden Lehman default, as we did with Enron, the CDS market has had some tests in the past, and it's passed them with flying colors. So I think the reason people spend so much time on CDS is because you can put that $40 trillion number out there. It's like these giant unnetted exposures that look super dangerous. I want to raise one other problem with CDS, though. People at CNBC and so on are using CDS as if the CDS spreads as if it's an accurate reflection of the risk of a Goldman Sachs. So if I want to create a bear rate on Goldman Sachs, I go buy a bunch of CDS, which are cheap, meaning they're 10 cents on $100 or whatever they were, and I say, shoot, I'll pay 20 cents. And then other people come in and say, I'll pay 40 cents for that because it doesn't cost very much. And if people insist on using the CDS spread as a measure of risk, then we're all doomed. There has to be a break at some point where somebody challenges that and says, I don't think that's a meaningful market, and I don't want to be stormed into this. If I start buying insurance on Steve Jobs' life, and it's pretty cheap, so I can buy, $1 million exposure, and then suddenly I'm buying $10 million and $100 million exposure, and then I let people know that there's $100 million of life insurance out on Steve Jobs. That's A, probably not legal, and B, it's sure going to storm the market. And so all of a sudden I've got $1 billion of life insurance on Steve Jobs, which doesn't cost me very much and doesn't have any relationship to the risk on his life, but it sure is going to affect the AOL stock price. And that is going on, and somebody's got to call a halt to it. Those are two separate issues. Is the CDS endangering the world financial system? I think not. Is it contributing to the bond rate? The bond rating guys actually look at the CDS, and then they rate the bond. I mean, that is a very unhealthy interplay.
Do you want to add to that, or go on to something else? Okay.
There was one thing, actually, I did forget. If American system, which is the capitalist system, is failing, then the culture of equities is also going to fail. And that's really important when you look at your portfolios. We, for a long time, have thought, actually, things like foreign exchange will make great portfolio substitutes. But really be wary of equity valuations with your assets. You're going to live with portfolios where everyone says it's worth twice as much as it is. And look at small E&P companies in the oil sector. And they do not realize their value. They don't realize their value. Goodness me, when you look at other activities. So I would really examine whether you wish to continue being heavily weighted in equity structures.
I want to agree completely with that. We've had a major devaluation of the dollar, and we shouldn't trust any prices. So if you say, is gold worth 800 or 500, the market really doesn't know, and we shouldn't pretend that we know. And then if you say, is GE worth 23 or 45 or 14, after a devaluation, you really have no way of knowing until you see the resolution of that, meaning how is the Fed going to recreate stability after this massive downturn in the dollar? We won't know what any of those things are worth. So I agree with that. And we may be seeing the end of equity. We all go on the basis that equities for the long term. Well, that presupposes, or that is completely in my framework of analysis, not in David's.
Good.
It's probably worth one other thing too. Is okay. So what else could you do if you're not into equities? I think cash flows are going to be really valuable because cash in the hand works. So one of the reasons why oil rigs fascinate me is once you've built one, it's going to print money and pay for itself in 3.5, 5 years. So find things like that people need that produce cash flows. And the other one is if we think energy security is big, In 5 years' time, food security is going to be the hottest topic in the world. You look at the climatic change conditions on production, you look at the demographic shifts in the world, you look at the protein substitution for carbohydrates, you look at all three factors and it's inescapable. There is not enough food. And we will pay whatever price to live. So I think food security is the hottest topic.
Can I ask a question on that? Back to the 1980, that was the underpinning of the malaise, the deep global crisis, and it led to the zero population growth movement, that there were too many people, an infestation of human beings. Aren't you saying the same thing? What happened? Why did we think in 1980 that the world was running out of food, and then for 20 years we found that everybody in the world could produce food? China became a food exporter.
Well, let's look at a couple of things that make that picture up. First of all, there used to be twice as many hectares under agricultural production per head on the planet 50 years ago. Agricultural investment has been zilch relative to other areas over 50 years. Now, they're exactly right. Now, you get these minor points where you get a whole load of feelings around the world's got too many people, and then it goes back down again and says, you see, you're over-worried. But the thing that's important about too many people now is it's not just the number of people, it's the number of people in industrialized centers. Because the resources required to feed industrialized centers goes through the roof. So the number could have been the same since the 80s, but stick industrialization into China and India, and you see the answer alone. Then you look at the effect of that industrialization, and I'm no doubt that we were prolific on the planet because the right climate allowed us to prosper. But now we've industrialized, we are modifying the climate, way beyond any point where we can change it. It's here to stay. It doesn't mean everyone gets hot. It means in some places it's hot, in some places it's wet, and wherever you optimize your crops, they don't produce yields anymore. So that's different. That's hugely different. If you look at the World Bank's assessment of production in Africa and Southeast Asia, it's 50% less at current rates with climatic change. Go to Britain and go and speak to a farmer who couldn't get his wheat out of the ground for the last 6 weeks because it's rained solidly. That's a good example of the problems that we face. And on top of that, as energy prices go up, your input prices go up in terms of fertilizers and everything else you do. So there are things actually that are different. And what alarms me is, if I'm a Kondratiev follower, 1975 was the peak of a Kondratiev wave. So you would expect all those feelings. What worries me is we're 7 years into 25 years, and we're behaving as if we are at a peak with another 20 years to go. That tells you that something has fundamentally reached a limit in a closed system.
I think the other thing to point out here, and I think both of you would agree, is that 5 years from now we could be severely challenged in terms of the buildup of protein that we'll need. That will also be severely limited by a lack of water on the planet, and the two combined are self-fulfilling. One thing I wanted to just add, and then we'll open it up for questions here, is just to take some of what they say and what the two Davids have said and just give you a bit of our view as to where we think the opportunities lie, where you can make money today, and what are the strategies to avoid. We think going forward that macro is going to be an extremely positive environment. We think that being in a tactical trading environment in these particular economic times will be beneficial. Vol strategies, sized right, will be beneficial. Managed futures, we think, will be quite strong. Emerging markets, I would stress alpha strategies over beta strategies, and FX and commodities. Commodities being in what we would consider to be, at least for the next 6 to 12 months, probably heavy on the supply side of the balance sheet, not so much not as a result of increased supply, but because of potential diminished demand that seems to be evident as a result of the economic malaise that exists. Places to avoid, equity strategies, in particular long bias strategies, which long-short equity managers tend to be long bias strategies. We don't think that taking a bullish view of being long 120% and a bearish view of being long 25% is going to represent a positive NAV to investors. We also think that staying away from high yield and distressed in this environment is a good thing to do. There seems to be a rush around the planet to get into distressed plays. I think that people need to remember that for distressed to be successful, you need a bull market. And there will be opportunities to buy. There will be great opportunities to invest in distressed markets in the future. But I think that the opportunity is so great that we can sit back and let the market show us when the right time is to invest. With that, I'd like to open it up. And, Steve, I know you've got 17 questions today. But let's start off with you.
I want to know, in light of Mr. Merrin's sartorial statement, I shouldn't take my jacket off. But it was very provocative in your insights and discussions and history lessons. I guess one observation is that once the Goldman Sachs mafia, i.e. paying Paulson, Rubin, get done merging everybody else, they'll take who they want to go to, and it may actually be Wells Fargo. So, but it ties into my comments, which this is a meeting that last night with some of you over here that Don Putnam had at Grail at Rites of Passage and alternative space. Question. Seems like we're rushing head forward to the universal bank model in the States. And the universal bank model in Europe seems to be a little flawed. So the question to both of you is, what is that impact going to have, regulatory point of view, but on risk-taking and on returns if we all go to a universal bank model in the States and in Europe? What's your take on that?
Yeah, so I'm not a fan of banks in general. I don't think the economy runs on credit, so I don't think it's a big delta on our growth rate to have banks hamstrung. They shouldn't be at the core of everything. So I agree completely with your point that we're moving toward a universal bank model that will be less productive, less innovative than the model that we had, more like Europe. And people will have to find other ways to get growth. So I really don't agree with the common observation that growth is credit driven. That's not really where growth comes from. It comes from sweat equity, from small businesses and so on. And the banking system, an antiquated banking system, a very conservative banking system, is fine for that kind of model. During the transition, so I went very negative in August of 2007 on the idea that securitization was a growth driver that had been lost. But then then what I think we're in is the transition from that old pipeline of very aggressive, heavily leveraged projects to a new pipeline that's based on saner lending standards, and I think there's enough throughput in the banking system to be doing that. We're seeing C&I loans, normal loans, and the transition isn't as destructive as you might think. You can have deleveraging, as I described it for the CDS market. Deleveraging is not nearly as terrible a thing. The reason Wall Street hates deleveraging is all the jobs go away and the big bonuses and so on. But from the standpoint of GDP, you just collapse the leverage and then go on with a better model.
We run the risk of having regulatory shift.
Huge risk, just like post-Enron. So the Sarbanes-Oxley, remember, passed the Senate in 97 or so to nothing and was disastrous for U.S. growth subsequently. So if we see that, and we're obviously seeing that. I addressed that in the Forbes article and in our research for clients that as the Fed is ever increasing its sweep, this is a huge negative. Gold went up yesterday in part because the Fed took an equity position in AIG. Can you imagine? And the Fed is now going to be central to regulating Fannie Mae, Freddie Mac, and the investment banking industry. This is crazy.
Paul?
Yeah. If you're going to have a deflation, one of the reasons people say that the savings rate in the U.S. has declined is because you had a fairly rapid rate of asset appreciation. Cap rates generally drop. So if we're going to have something like your reversion to saner spreads, does that mean that we're looking at a structural increase in the savings rate over time? Does that act as a drag on the U.S. economy for the foreseeable future? and neither of you discussed the current U.S. election in any question as to whether or not you're likely to have a policy response that would change either macroeconomic policy or growth paths for the U.S. economy going forward. Do you regard it as an irrelevancy in the greater sweep of human history, or do you see the candidates as relatively similar?
I've written a lot on the savings rate. So remember, the personal savings rate that comes out of the Commerce Department doesn't have any meaning in the numerical sense. The Fed puts out the correct measure of savings where they add up how much people are saving. And what we see there is $3 trillion of money market funds, a very high amount of savings in the U.S. household sector. So your question was directed at, will people consume less, meaning the consumption growth rate going forward. I don't think will be affected by the wider spreads. If anything, remember the household sector is a giant net creditor. So having higher interest rates is a big positive for the household sector. One of the problems in Japan is their household sector, like in the U.S., is a big net creditor, and yet the interest rate is just 0.5%, so their consumption doesn't grow. So I see the new environment as being as conducive to consumption as the old environment. On the election, I've written about that. We won't know until next year how Obama, if he's president, will tackle the tax problem. And with regard to the regulatory framework, we've seen McCain talk about a 9/11 commission, which is a non-starter as far as the current crisis. So I just don't think the election right now is very relevant to what we're in an all-out crisis, and we're stuck with Bush and Paulson, and there's no getting out of that. So there'll be a giant sigh of relief in November, whoever wins, because it's going to represent regime change for the positive. That's my view.
There's also a point which you made about banks. If you go north and you look at Canadian banks, it's really interesting. We're very close to Toronto Dominion. They own some of us. And Toronto Dominion has a phenomenal balance sheet because it's a traditional bank in a growing economy. The banks that we know of in Britain, because we've done exactly the same, and America, have allowed this migration to risk as liquidities come into the system to hold up an overextended system. This past 5 years has been a complete anomaly. So the one thing I'm convinced of, you won't see banking structures like this for a long time ahead of us. And normally when you've taken a huge risk hit, you become completely conservative. And I suspect that this financial dynamic where there is a contraction of wealth, and most of the people in the street are currently taking the attitude, hey, those rich city slickers, they deserve everything they get. What they don't realize is this is going to run through in ripples to their everyday lives. And so in answer to your question, I've pondered what outcomes in the election would be able to change America's future, because not everything is predetermined. There are ways of extending the cycle or contracting it. And unfortunately, the first observation I have about Western politics, which is consistent with mature systems, is that the truth is, what are the chances of bringing a radical individual into leadership who has completely different, aconsensual ideas that can make those changes? None of us. We don't have them in Britain. You don't have it over here. The only example is McCain's running mate. And I suspect that some of the resonance was that people looked at her and said, you're not like the others. Mm-hmm. You're not an old politician of the old mould, and God, please get rid of them so we can have someone else. So I actually, whether it's one or the other, they don't have enough power and ranges to change the outcome. And the very system itself is at a phase where that happens, and it's normal. So I see it relatively irrelevant. There's one direct area that is defence. When a system declines in power, if you show any weakness, and Obama to me represents weakness for American power projection, and McCain represents strength, so that's the biggest difference to an overseas power. The issues are not internal issues for you, it's how the outside world perceives you. And if Obama gets into power, you can bet your bottom dollar that Iran is the beginning of a sequence of proliferation. Whereas if McCain gets in, probably the problem we solve. I think it will be solved beforehand. And in terms of risk quotients, I think you have to be very aware of the dual program the Iranians are running, and the Israelis cannot tolerate this mechanism. In fact, if America is losing power, you should really consider whether you want to be anywhere near Israel. Israel exists because of American power. If American power contracts, it's very vulnerable. And start thinking about satellites of America like their old traditional empire model, and you'll see those vulnerabilities. And that's what Iran sees. And that's why Iran has been so aggressive and continues to be. It believes America will not counter them. And I hope they do. Honestly, this is one big risk that we cannot take. Because if you give it to the Iranians, the Sunnis will do it. And the biggest risk to the West that no one talks about, that China's playing for, is can they radicalize the Middle East? And at the moment, there's a good chance they can. And if they can, you can say goodbye to all the oil that comes to us, because it'll go east.
One of the managers that I visited in London advanced a theory to me that he believes that someone will attack Iran while Bush is still in power, and that's one of the reasons why one wants to maintain some protection in oil, for oil to have a dramatic move to the upside, even though we are in a somewhat declining demand cycle. I can take. Yeah, go ahead.
I want to say on Iran. Remember, the Israelis had a cabinet change 2 weeks ago or so. That was one possible spot for them to do the attack. The U.S. just last week supplied the extra refueling capacity needed for the Israelis to carry off the attack, and I think it's very much tied to the election cycle. So if Obama is quite ahead, that accelerates the Israeli need to get it done under the Bush administration. So the polls matter. And remember, the strike comes when there's no moon, when you're in a darkened sky. So if you begin looking out the calendar, this is, I think, already all planned out within the defense community and kind of scheduled because of the point that you made. Israel cannot allow the situation to persist, and if Obama is looking like he's going to win, that forces the trigger.
There's something else also. If you look at, in fact, I've been studying this for 4 years. All the defense organizations are linear in their thinking. They have consistently underestimated the rate of enrichment in Iran. And it is really likely that they have a dual program. All secret entities in military history have had dual programs. So what you see on the surface is replicated somewhere else. And the risk of a breakout becomes higher by the week. And so I think that it may well happen and have to happen before the elections. And I think that American strategy is not dissimilar to what took place in Suez, with the relationship between Britain and Israel over the canal. I think you cannot open a conflict to be seen to do it on Iran under any circumstances. What you can do is somehow facilitate an Israeli strike through Saudi Arabia. And the Saudi Arabians would love this to happen, but they'll say, hey, those nasty people flew through our airspace. And then you will end up having to finish the problem off. Because you will. It's not going to be a limited strike. The Iranians will respond. And the stability of your withdrawal from Iraq depends on the diminishment of Iran's ability to project power. I think you've been incredibly moderate for 18 months in not directly indicting Iran for the instability in Iraq. It's remarkable how quiet America's been and how justified you would have been to complain.
Somnolent, as we see in George as well, meaning the Bush administration has just been entirely asleep and inactive on these issues.
Well, with that high note, I think it's appropriate to wrap things up. And I would like to say thank you to both of you for an extremely engaging, interesting exchange. And Steve, I'll turn it over to you.
Well done, well done. I want to remind everyone that Matt O'Connor at Quinnipiac will be coming out with a phone survey, and this is your chance to answer the questions that you couldn't ask today, and if you would ask them on that scorecard. Secondly, our programming committee would like to know from you what should we be talking about in 2009, so if you can give us some suggestions on that card. Excuse me, we'll meet here back on October 16th. The topic will be surviving the down and prospering on the turn. Ted Brett Barth will be moderating that session. And finally, I want to make a note of something that Vaso has just uncovered. We went out with a contribution letter, and someone sent back a $500 contribution, but they asked that contribution be applied towards the membership of their alma mater, the chief investment officer of their alma mater at their endowment, that person become a member. And that's a wonderful idea. So I'd like to pull out my tin cup and ask you, if you do make a donation, that you make a donation for your alma mater or the endowment that your alma mater has, and we'll get a new member, and your alma mater's endowment will get good information and some ideas from us. Finally, I'd like to thank Todd Purcell and RBS Greenwich Capital for underwriting today's session. Todd couldn't be here. He's sitting watching his terminal and staying very close to the phone. But I must say that RBS has underwritten all these very terrible earth-moving sessions, and it is not in their commercial interest to do that, but we want to thank them for doing that. And the two Davids, thank you very much. This is very thought-provoking. Well done.